Good morning. It is Tuesday, January 24th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Stasi. And here are the three things you need to know as the clock hits 9 a.m. Earnings coming in hot. We've got results from General Electric and 3M, with 3M announcing job cuts as demand for products fell apart at the end of last year. We'll break it all down in just a few moments.
Plus, Sundar Pichai gets defensive. Alphabet CEO pleading with staff to remain motivated despite announcing that executive bonuses could be cut.
And funding really was secured. Elon Musk reveals he could have taken Tesla private back in 2018. We'll bring you the highlights from day 2 of Musk's testimony in just a bit. But first, let's get a check on the markets on what is a very busy morning so far for earnings. We're seeing all three major indices in the red here. Dow down more than 150 points in the pre-market. But let's begin today with our top story. That is 3M. 3M is having a rough earnings day. The manufacturing giant missed on profit estimates and announced plans to slash 2,500 jobs. A major sign that layoffs are expanding beyond big tech. Very key point there as well. A lot of this layoff news has been confined to big cap tech names, of course, Amazon, Microsoft, etc. But this 3M quarter was a really comes following that Newell warning yesterday, I think, and we talked about a warning on the health of the consumer. Sales under pressure for 3M. Inflation remains high. That impacted profit margins for this business. And you have 3M coming out here with a pretty deep earnings warning to kick off the year, and also announcing 2,500 job cuts in the manufacturing sector.
Yeah, growth for the company has really started to decelerate or even slow. And you look at this year over year and what the past few years have looked like there. I think what investors are going to be hoping or looking for in terms of more clarity is when some of that demand starts to return for 3M more broadly. Everything from your Post-it notes all the way to us using N95 masks or just masking up when we do see spikes in COVID. 3M is a part of that. And so within the demand category, or the demand kind of acceleration, demand generation is going to be a big concept that I think a lot of investors are going to have to learn about, especially in any type of economic downturn, or when you do see large orders start to pull back from some of the.
When you see deflation in Post-its, you just write it in your hand, Julie. You just write it on your hand, you keep it moving. There we go. Julie, I just tried to write my name on your hand.
Okay. Well, you need to show people what you're writing on your hand.
I'm trying. I tried to write Julie. I mean, that was my Post-it note take.
Couple points I want to make here. This is not a new problem for 3M, first of all, the demand slackening that we are seeing. In 2022, the company twice cut its full year profit and sales outlook. So this is something that's been ongoing. So that's the demand side. There's also some other issues, some other liabilities that 3M has been dealing with for a while here. Allegedly defective combat earplugs. Remember that case that the company has been undergoing. And then there are the PFAS, right? The forever chemicals that are in many of 3M's products. And that's what they've been dubbed forever chemicals, because they last forever. They don't break down. We all have them in our bodies because of various products that we use and have access to.
Can I get rid of it? I don't want PFAS in me.
They're called forever chemicals for a reason. Anyway, the company does plan to stop producing them by the end of 2025 because it's come under pressure. But those are just a couple of sort of background issues as it faces these foreground issues of what's going on from an economic perspective, and that slackening demand.
Also, one final red flag here: slowing in China, called out too. At top of the earnings release here for 3M. So it's not just a U.S. slowdown, also calling out weakness out of there.
Also want to mention GE here this morning. That's another company that reported. And I was actually paying attention to the earnings call on this, just listened into the webcast for a little bit. And beyond some of the numbers that they reported, what the CEO and some of the executives were saying on the call, everything from leadership roles, half of their business leaders are actually new to their roles. Of course, this is also a business that has spin-offs that are moving forward, specifically within that healthcare division. But they've got some orders and revenue that was up 20% in this most recent quarter. I think going forward from here, what they did say, though, was that the next 6 months would be challenging, and this really comes back to some of the shifts in timing across the size and complexity of the projects that they're working on with specific customers. So that little nod warning in the call this morning, but again, at the same time, I was looking at shares, tracking them in tandem with the call, and they still held on to gains pre-market as well.
Yeah, we saw initially some strength here in GE, but those gains have been reversed. I think the market initially bid up GE shares on what looks to be an improved free cash flow outlook this year versus last year. GE looking for $3.4 billion to $4.2 billion in free cash flow this year. That clocked in about $3.1 billion last year. But now the reversal, maybe part of those comments on the earnings call, Brad, but also For this year, GE looking for $1.60 to $2 per share in earnings. Consensus, according to Yahoo Finance data, was $2.37. So effectively a warning from GE, not unlike we just heard from 3M.
Yeah, cash flow was really the story there for so many years. Maybe the focus is now shifting to the bottom line instead. And what I'm also seeing here, as you consider the three parts of GE, healthcare, which is now separate, and then you have the power business and the aviation business. Remember, power's going away. It's going to be GE Vernova, and then what will remain eventually will be that aviation business. The power business is not doing so well. It has been struggling, and it does continue to struggle. So that's something that analysts are commenting on as well. Even though it's going to be separated, for now it's still part of GE, and that part of the business is seeing a little bit of weakness here. Power revenue up 7.9%, coming in a little bit short of estimates here, whereas you saw aviation revenue beat estimates. Renewable energy revenue, by the way, is also part of that whole thing, and it's $3.41 billion in revenue there, a 19% drop. So that part of the business is still weaker than analysts have been looking for.
All right, we're going to continue to track shares of GE. Interesting call out on the call. They hope the Bengals win the Super Bowl here, so news you can use. Also here, the tech industry continues to grapple with major layoffs. Google executives are defending the job cuts and fielded questions from distressed workers during a town hall meeting. CEO Sundar Pichai conducted the meeting and told workers that executives will see their bonuses cut here. And of course, this is as we've been monitoring the backlash to some of the broader layoffs in the tech space, but for Google and the size, but also the different departments that were affected as part of this layoff, it seems that the pushback internally was really just questioning what the actual strategy was behind the different departments that had actually gotten cut within this. Again, at Alphabet, I mean, this is still a major advertising-driven business that's more than 80%, roughly 80% of their revenue, and they've got some big bets as well. So the Googlers internally really pushing back on how these cuts were made and just questioning the strategy to it as well.
And accountability, I'm starting to see that more and more in these layoff announcements. Where's the accountability among upper-level management? Sundar, he's not losing his gig, and his direct reports, they're not losing their gig as well.
But
I think it would have.
Their bonuses are being cut.
Oh, wow, they'll just get a couple $1 million while these workers are sent packing. The bottom line is executives like this get paid all this money to at least give some kind of guidance, I think, to employees when they may be canned and shipped out the door. And he didn't do his job, full stop. He didn't do his job.
Well, how do you figure he didn't do his job?
I think he could have guided to employees a little bit more. This is a CEO that has been aggressively hiring for the past 2 years. I think he would have maybe seen something like this, a slowdown might have happened, and maybe pulled back on how many people he was hiring.
I mean, but this
or at
is
least
happening at so many tech firms.
Maybe cut back on some of these stupid projects they're working on that are not making any money.
But I don't know. I think you're jumping to a conclusion here, Saz. I mean, look at all the other tech firms that are also cutting workers. The way they explained it is that they have, and maybe this is part of the issue, they have 30,000 people in upper management. And so they said, well, we couldn't sort of give those people a heads up. It's just too many people to give it a heads up without the news getting out. I mean, listen, we've all been in this business.
I'm not mad at you. I'm just having a discussion. You're my best friend, so it's okay.
Don't worry.
No, okay, I just want to make sure I make that clear. I want to make it clear to the audience. I'm not, we're just having a discussion here, okay.
I'm mad at you, Saz.
Okay, all right, thank you.
And I'm mad at Brad, too. And I'm mad at anybody else. No. So, anyway, that was how they explained it, right? We have all been in our working lives long enough to know that these things are, frequently not managed as you would idealize that they should be managed. But there's not really an ideal way to manage layoffs. Now, should he have managed it better in the first place and not hire so many people? I mean, hindsight 2020. I don't know.
Right, and it was a much different environment and perhaps that is where some of the scrutiny can come into play. If you're just continuing to believe at the executive level that you're always going to have this tailwind or wind in your sails that is going to power the business, have a constant kind of demand environment that is favorable to the type of growth that they were forecasting for, hiring for as well, then that's foolish. It's naive as a leader of a business because there's always going to be that cycle where you're going to have the downturn on the other side perhaps. But I think what they could have sensed was that, yeah, if you have a portfolio or a client base that has already done a ton of spending into some of the applications and the infrastructure that they need, then why would they continue to spend
Guy's on the mark.
at the same level?
He's on the mark here today. He's on the mark. Nailed.
Just saying.
Nailed.
So you're not mad at him then?
No, never. Just you.
All right. Let's talk about someone who maybe has some anger issues. I don't know. That's the subject of another debate. Elon Musk told jurors during his ongoing securities fraud trial that he was sure he had secured financial support from Saudi investors in 2018 to take Tesla private, and that his funding secured tweet back then was not a joke. Yahoo Finance's Alexis Keenan has the latest. It's hard to know, Alexis. I'm not mad at you, for sure.
Thank you.
It's hard to know if he's sort of rewriting history here, but what did he say in the courtroom?
Yeah, so he basically gave two reasons why he said he thought that his tweet was true. And of course, we'll show it on the screen. We're talking about that now, which he also called infamous tweet in August of 2018 when he said he had funding secured to take Tesla private at $420 per share. He said that the price, to your intro there, that it was a coincidence that it fell at $420. So, well, take it or leave it. So this is a suit where Tesla shareholders say that that tweet caused them to lose money because they bet on the stock when it was artificially pumped up when that comment was made and then fell back down over a 10-day period. And we have a chart there to show that. But first, Musk's two main arguments here, I would say. One is that he said the Saudi Arabia Public Investment Fund had made a verbal commitment to help him take the company private. He said he then got concerned when he got news that a Financial Times report was coming out that would disclose that the Saudi fund had acquired a 5% stake in the company. That was non-public information at the time. He said he wanted to get out ahead of any additional news that this news organization might have. And so he sent this tweet because he had already been engaged in discussions with the Saudi fund months and months before that. Now, secondly, Musk also said that he had another backstop, and that, he said, was that he could sell. He said it would break his heart to do so, but he could sell SpaceX shares in order to fund the deal. Also said that he had a funding commitment from Larry Ellison. Now, time for the legal lesson. What Musk actually believes about the truth of that statement and some other tweets that followed, that's what the key is here, because the judge in this case, oddly enough, has already ruled that the statement is false. He's not going to let the jury decide if it is or it isn't. He said it was false. So here are the elements of the case. To win, the shareholders have to prove that the tweet was materially false. Got that one, thanks to the judge. Second, that Musk knew it was false. And third, that it caused the shareholders to buy or sell the stock to their detriment. So that is why Musk is talking so specifically about what he thought about those tweets. Two admissions, importantly, also came from Musk yesterday on the stand. He said that the fund had not signed any official documents to memorialize this funding. He also said that he did think that the stock price would possibly increase on this news. He also admitted that he sought no particular legal and financial advice to try to put together this deal. And so the lawyers for the shareholders was making the point that, well, why would you tweet that funding was secured if you hadn't even had those professional consultations as would normally be done in the regular course?
Just kind of backing out, what's at risk with this trial, particularly here for Musk?
Yeah, so the shareholders have not specified a dollar amount of damages in this case. But with the help of Jared Blickery, we have put together the market fluctuation during the time that the shareholders say this 10 days, August 7th through the 17th of 2018, they say that that was the time during which they bought or sold shares to their detriment. That time period comes out to a fluctuation in market cap of about $12.6 billion. But that is up to the jury to decide. If Musk is held liable, then the jury gets to figure out what the dollar amount of those damages is. That's a calculation that's a really tricky one for any jury, I would say.
Now, I'm curious if they're trying to make the case that, in fact, he knew that the funding was not secured. Are we going to hear testimony from the Saudis, for example, or from, say, a Larry Ellison or whoever he would talk to if he was actually considering selling a SpaceX stake?
That was a big point that went on during Musk's testimony from both sides yesterday, and that is that Musk's attorney did try to subpoena representatives of the Saudi fund. Of course, they're outside of the jurisdiction of the United States. They did not show up, and they probably will not show up at this point in the the case. Yeah. So no. So that's a problem for him, right? And Musk he said to the shareholders' lawyer during his testimony, he said, you would lose your case. It would fall apart if we were able to call these representatives and they had to testify under. Yes. So that's not going to happen. As far as Larry Ellison, we'll see if he is going to testify. Musk is still on the stand, so his testimony will pick up again at about 11:30 Eastern time today.
All right, we're keeping tabs on this. We know you are as well. Yahoo Finance zone, Alexis Keenan. Thanks so much for breaking that down for us. Guys, coming up on the other side of the short break, why our next guest says it's premature to determine if the labor market can maintain its relative strength. We're going to speak with Charles Schwab, Liz Ann Saunders next. Recession fears continue to mount, and leading indicators are pointing toward further economic weakness. But what would be the tipping point that actually pushes the U.S. into a recession? Great question you asked. Joining us now to break that down is Liz Ann Saunders, the Chief Investment Strategist over at Charles Schwab. Liz Ann, great to see you this morning, and thanks for taking the time as always, particularly within your 2023 outlook. I was particularly interested within this that you've described as a rolling recession, or a recession of the rolling variety. Perhaps you can break that down for us.
Yeah, and that's unique to the COVID cycle. So if you think about the point at which stimulus kicked in, you had this pent-up demand, but because we were still in some form of lockdown, all that demand was forced to be funneled into the goods side of the economy. That then became the breeding ground for the inflation problem we're still dealing with. But since then, a good chunk of the goods side of the economy, including housing and many things housing related, some tech areas, some consumer areas, have gone into what could be defined as recession. You're now in disinflation, if not deflation, in those goods inflation categories. But we've then subsequently had the pent-up demand on the services side. That's where the inflation is most sticky at this point. And I think because services employs more than the good side of the economy, that helps to explain why the labor market has been relatively resilient. So that's the nature of a rolling recession.
And, I know we've talked about this a little bit before, Lizanne, but we all know things are slowing. There's all this debate about whether we're in a recession, whether it's going to be this rolling recession that you described or not. Why does it matter from a consumer and an investment perspective if it is technically a recession? Or does it matter? Is it just the sort of slowing that's the important part?
I think if we were having this conversation a year ago and we were just off all-time highs in equity indices, I would say it would matter a lot. But at the October lows, S&P was down 35%. Whether it's ultimately declared an actual recession by the NBER, which always comes, well after the peak in economic activity, I'm not. It's almost more academic at this point. That said, I think there's the feeders into the consumer confidence side of things as well as consumption. And that's more a function, I think, of if we start to see more headline deterioration in the labor market. That's when I think the pinch will be felt a bit more. I'm not sure it has as many implications for the equity market from here, given the bear market that's been already underway for more than a year.
Lizanne, how concerned are you about what appears to be the spreading of these layoff announcements? It started in tech, but you got news today out of 3M saying they're laying off 2,500 people in the manufacturing sector because of slowing demand. How concerned are you about that?
I think it's going to get worse from here. Every leading indicator suggests that the labor market will weaken. In addition, you've got the Fed. Essentially, they're not gunning for a higher unemployment rate. They've got an unemployment rate about 1% higher than where it is right now in their dots plots and their economic forecast. But what Powell and pretty much every member of the Fed has been very clear about is they want to see a significant dent to labor market demand, sort of crush job openings without causing a significant increase in the unemployment rate. Now we are starting to see some pretty sizable layoffs. Interestingly, they're larger companies, and they're more on the goods side of the economy, where you're still seeing hiring on the services side of the economy. What it should have the effect of doing is continuing to bring down measures of wage growth that are done with averages, like average hourly earnings, because you're now increasingly taking larger wage jobs out of the mix. And the services areas that are hiring, leisure and hospitality as an example, tend to be on the lower end of the wage spectrum. So that's the way the average works. You take some of the larger numbers out, it's going to bring it down. That may be some false hope, or maybe actual justified hope on the inflation side, but it's not necessarily a great sign for the economy more broadly.
Within kind of the energy equation that we've been tracking last year in 2022, and then even further into 2023 as well, it still continues to be one of the preferred plays out there on the street. Within the GOP House vote that's scheduled for this week on an SPR bill, it's particularly being monitored because this is tied to perhaps the drawdown in 2022, efforts to refill this year as well. Is there any broader economic impact that you anticipate from that if it does go through?
I don't know if there's broader economic impact. It certainly is a tricky situation when you're trying to replenish what you took out at prices that are not necessarily beneficial. And that, of course, is tied in part to China's reopening after the lengthy period of lockdown. So I do think from a demand perspective, and whether ultimately the price is right for replenishing those stockpiles, a lot has to do with the trajectory of China on the demand side for oil.
Liz, and finally, as we look out here into 2023, is there one sort of message that you want to impart to investors more than any other to help them make money this year? Is there one theme that you really have high conviction on?
So we have the return of the risk-free rate, courtesy of the aggressive Fed cycle, and that is reconnecting fundamentals to prices. It means there's price discovery again. One of our big themes has been taking a factor-based approach and focusing on factors that represent what's dear or missing in the market. So strong free cash flow, strength of balance sheet, positive earnings revisions, pricing power. But it's also been an environment where active is having its best year relative to passive in an very extended period of time. And I think that in large part is to the benefit of investors, to the benefit of stock pickers. I just think for now, you don't want to fall into the trap of going way down the quality spectrum into some of the meme stocks. Stay with those quality-oriented factors, but apply that screening across the spectrum of sectors as well as cap ranges and even growth and value from an index perspective.
Charles Schwab, Chief Investment Strategist, Liz Ann Saunders. Always a treat to get some time with you. We'll talk to you soon.
Thanks very much.
Coming up, Johnson & Johnson is serving up a bullish outlook for this year. We'll discuss that, plus have the opening bell on Wall Street next. All right, ahead of the opening bell on Wall Street, we have a lot of earnings to cover, so let's get back into some of that fun action. Johnson & Johnson coming in with mixed results as sales fell over 4%, but the company issued some strong guidance for the year. Let's bring in Yahoo Finance senior healthcare reporter Anjali Khemani for more analysis here. Anjali.
That's right, Brian. So Q4 was a bit of a struggle there, in part because of some of the external factors. We know, of course, the stronger dollar really did push some companies into the negative there. We also saw high demand, though, from the consumer side on products like children's Tylenol and Motrin, and so that really helped buoy the company. They are looking at what the impact will be moving forward, especially knowing that this consumer brand is going to be spun off into Kenvue. Looking forward for the year, though, strong outlook, especially as pharma is getting a boost, the pharma sector and medical devices in general. They expect a strong outlook considering that, demand is starting to pick up again, especially for some of their blockbuster drugs. So that's really where the company stands right now in terms of what the outlook is going to be. And of course, we do know that they are winding down their COVID-19 vaccine just as the FDA is about to meet this week to talk about what the annual strategy is going to be, including for J&J's vaccine moving forward.
Thanks so much. Appreciate it, Anjali. And we are just a couple minutes from the opening bell here. We were excited a moment ago to learn that U-Haul is going to be ringing the opening bell here.
Love U-Haul.
U-Haul Holding Company. Apparently, it just renamed itself and now is trading on the New York Stock Exchange. It was, I believe, called Amerco. That was the parent company. And I was just reading up a little bit on the history of the company. It was created by Sam and Anna Mary Schoen back in 1945.
With a 1937 Ford. Let's hit another ticker there, Ford.
Yeah, exactly. So it's pretty cool that now they are becoming a public company.
Yeah, that's pretty cool.
I didn't realize the history of this company. They realized there was a need for people to pick up trailers in one place, drop them off in another. They painted off the jump, they painted the trailers orange, put U-Haul on the side.
They've all got different art and designs on them too.
Makes you wish you were alive in 1945. We could have come up with that, Julie.
Does it?
Yeah.
I'm sure I could come up with the idea today. Really want to, but I'm happy doing what I'm doing. So anyway, there's the opening bell for U-Haul on the New York Stock Exchange. And in terms of what we are watching here this morning in markets, we continue to watch what's going on with earnings. We continue to watch tech stocks in particular because they have seen such a bounce this year. And after the big gains on Friday, we had initially, or yesterday I should say, we saw the Nasdaq continue that rally, but it has come to an end as of today, at least for the moment.
Well, they have no more layoff news, Julie, these tech companies. So, I mean, the stocks are not going to go up.
Right. That's the thing that's been juicing the companies, in some cases at least, although it's not helping 3M today. It's layoff news, non-tech news. Brad, what's going on over there at the Interactive? What are you seeing?
Yeah, well, I'm seeing some red here out of the gate this morning. Dow Jones Industrial Average, that's down by about 0.5% to start the day. You got the Nasdaq Composite also down by about 0.5%, and the S&P 500, same on a percentage basis there. Let's take a look at some of the sector activity that we're tracking out of the gate this morning. 11 S&P 500 sectors. You know what it is, folks. It's, oh, wow. Okay, we got some interesting movement here. XLP, you got your consumer staples up by about 0.5%, leading the charge here. But you know what it is. Time to check on the caboose of the train here. Real estate, that's down by 1.9%. Yes, actually, you can trail a lot of things with those U-Haul trucks as well. Being trailed today, XLRE. Also, taking a look at the Nasdaq 100. A lot of red here on the screen here. We'll give you a good picture of who's leading, who's lagging right now. And right now, it's Peloton. Peloton's down by about 5.3% this morning. But look no further for some of those leaders. Right now, you've got PCAR. That's the ticker symbol, and we'll get into that one a little later. Dollar Tree also leading the charge. That's up by about 1.7%. But some of the leaders today, few, far between. So we'll continue to keep a close eye on that. But bringing up the rear, you got Lucid, AMD, Lululemon, which we'll talk about later, and Peloton.
Yeah, it looks like Peloton caught a downgrade from Baird here this morning that is responsible perhaps for the declines that it's seeing. The analyst there said that the numbers are going to be weaker than estimated because of accelerating demand for in-person gym memberships and softer indications of consumer demand for at-home fitness.
I'm down to 2 rides a week on my bike, to that point.
Yeah, but are you going to get rid of it?
No. Not at all.
Then
And they're going to stop telling us those figures too. The average connected fitness workouts, that's going to be a figure that we don't get in earnings going forward.
Oh,
Peloton, pedaling lower, Julie.
Let's talk about Verizon also this morning. That company was out with fourth quarter numbers. Coming in mixed, revenue topping expectations, but the company did issue some weaker than expected guidance for the fiscal year. They're expecting revenue growth to top out at around 4.5%. You can see earnings and sales came in bang in line with estimates. Really here, what you got to pay attention to is the number of subscribers. Subscriber growth, 217,000 in new wireless subscribers. That did top estimates, although it's way below the growth that T-Mobile has been seeing. That company continues to gain market share. AT&T reports tomorrow it's expected to have higher subscriber growth as well. But I guess maybe the bar was low coming in here for Verizon. With that subscriber growth beating estimates. Broadband, by the way, also beating estimates. So that's also something that's working for them.
Investors may want to reread this earnings release, and I would really go down to their consumer business operating margins under severe pressure in the quarter. And oh yeah, they also issued an earnings warning for the year. Again, another company that, to your point, Julie, that has really taken a back seat to T-Mobile for more than a year in terms of growth, postpaid, prepaid, you name it, really just taking a backseat to them. And then AT&T, I would argue, CEO John Stankey has finally, I think, started to turn that company around. They have reported a couple decent quarters now under their belt since they spun off that media division. I'm just confused what the market here is trading up. And especially, my bill is getting expensive.
Right.
I'm a Verizon customer. I just got my cable bill. I have a no-frills bill. I'm paying almost $170 a month. Don't even know what I'm paying for at this point. But now I'm starting to reevaluate, do I even need any of this in my life? Should I just cut the cord and save a few bucks? It's ridiculous. The bills are absolutely ridiculous.
You're contributing to some of that consumer revenue increase. That was up by about 4.2% year over year, and they're driven by the wireless service revenue, particularly here. Now, you look at some of the investments that they're making too, and that's where perhaps consumers who are perhaps investors in Verizon as well are reading through this report and saying to themselves, okay, they're making so many different investments in C-band specifically. Spending in CapEx last year, full year, $23 billion. Who do you think that gets passed through to as well? Some of that comes out of that free cash flow, but yes, Sazi, that shows up in your bill.
It's a big bill. It's a big bill, and the charges. I mean, the bill is actually getting longer too with all these various surcharges. It's almost becoming unaffordable.
So cut down your.
I should.
I mean,
I don't have anything special. It was supposed to be a basic plan, Julie. $170. It's huge.
Yeah, I think we're.
Maybe you'll have to. And really, if you help me out, because I'm going to need to cut something.
Something else I want to mention here is that Verizon has been burning through heads of its consumer business. And now Hans Vestberg, the CEO, is acting as consumer chief because the company does not have an actual consumer chief. What's really going to be key for Verizon and for the other phone companies right now is how much to offer in discounts. And Verizon seems to be holding the line here that they are not going to be offering more discounts on promotioning on the phones, et cetera. Although the last time I checked, you could still get a free phone, but maybe that's because I'm up for renewal or whatever.
I have been getting a lot of free.
But maybe they're not going to. Maybe they're not going to do
alerts.
more. Maybe that's the idea here. So maybe also that kind of commentary leads analysts to believe that margins are not going to deteriorate. Maybe that's one of the reasons that the stock is up too. But the trend for discounts in the industry is really an interesting one for sure.
Right. Less discounts. What does that also mean for customers who are still paying their bill on time or even in a delinquent manner? What does that mean for delinquencies too, as you have some of the rising prices for these services? So that's perhaps something to keep a close eye out for on the wires as well, or any chatter around the company. Also reporting earnings this morning, Union Pacific Corporation, ticker symbol UNP. This came short of expectations on both the top and bottom lines as operating expenses jumped over 14% year over year. This was headlined by fuel prices growing 43%. Keeping a close eye on shares this morning. I believe we had them on the screen a moment ago here. But for UNP here, I think what they also pointed out within this report was revenue growth offset by some of the elevated operating expenses and operational inefficiencies that they did highlight as well, higher inflationary environment, but saying that they made good progress on employee safety. Remember, just this time last year, there was a lot of questions about employee safety as you had some of the looting that was taking place in the West Coast of the different railroad operators as well. And so that this time last year, now a different picture perhaps as they kind of prioritize just making sure that their staff was safe in the operations as well.
And I'm using a lot of these industrial reports just to get more clues on the economy. So you had 3M, 2,500 layoffs in the manufacturing space, disappointing revenue outlook and earnings. GE, earnings warning for the year for them, little sluggishness in terms of operating revenue for them. And if you look at Union P's earnings release, they're saying they saw a 3% drop in quarterly freight car velocity, and then the average train length decreased 1%. Not exactly a positive sign in the healthy economy.
One good thing to point out here, one of the reasons maybe the stock is up, the adjusted operating ratio, which is something that the railroads are really measured on at 61%. That is above the estimate of 60%. And it's also, that was a level that the railroads have been trying to get back to sort of post-pandemic, right? Mm-hmm. They wanted to get that operating ratio at the 60% threshold. So that is a measure of success, I think you could say, for UNP. And that's something to ask Lance Fritz about.
That's right. Coming up at 11 a.m. today, Lance Fritz from Union Pacific is going to join the show to break down those earnings that we just discussed here. Stay tuned for that conversation. Coming up, Yahoo Finance's Jared Blickery is going to break down the latest market action amid this busy earnings week. That's coming up on the other side. Don't go anywhere. Welcome back to Yahoo Finance Live this morning, everyone. Major averages fractionally lower across the board. For more on today's tape, let's get on over to Jared Blickery at the Wi-Fi Interactive. Hey, Jared.
I had a whole spiel planned here, but we got to focus on some trading glitches at the New York Stock Exchange. We had some price halts, some volatility halts on the open. Let me just show you. Walmart is now trading normally, but that was not the case just a few seconds ago. This is an intraday chart. Let me put it on the 2-day chart. You can see on the open, it spiked up here. It was about 8% on my quote board, and then it was frozen. It looks like some kind of halt, and now it's trading back. So we don't know if those trades are going to be decayed, that is erased from existence, or if they're going to stand. McDonald's was another ticker. We saw some meme stock action, some of the meme stocks, but it looks like things are kind of settling back to normal here. So let me just get to the market breakdown. As Brad was just saying, things in the red today, giving up some recent gains. Yesterday was a key day in the S&P 500 because it broke to a multi-month high and it's at a critical level right now. So far today, we're seeing a little bit of negative price action. Energy and industrials leading to the downside along with materials. To the upside, it looks like the 3 mega cap sectors are the least worst off. But let me just show you what's going on here in the indices, see if we can try and make sense of what's going on here. In terms of the larger picture, this is the 2-year look at the S&P 500. Just want to draw this trend line all the way down. We are now just barely breaking out of this. You take a look at the Nasdaq, it is a very similar story here, although it is much farther down in the lower end of its range. Suffice to say that the market could break up from here or it could turn down. Now, if it breaks to the upside, I've been saying that the Dow is no longer leading the Nasdaq. I would expect the pain trade to be in tech stocks to the upside, and that's if rates even go up. Now, if rates really do something drastic, then we'll probably see stocks roll over, and in that case, all bets are off. But bottom line, I think the major indices at a major decision point right here.
Jared Blickery, thanks so much. Appreciate it. All right, recessions are when McDonald's really thrives, as you can see in our chart of the day from Baird. The Golden Arches saw average quarterly same-store sales gains of 5.4% during the 2008-2009 recession as people sought out ways to save money. Nothing says budget watching and then like buying some chicken McNuggets to the drive-thru and the dollar menu. Coming up, retail recovery, so we could see overstock on expectations for the retail space in 2023. That's next.
Analysts are warning of further pressures to come for retailers, with inventory expected to remain high and further discounts needed to push product sales. Companies like Overstock are going to have to continue to battle with retail giants like Amazon and Walmart for more market share. Overstock CEO Jonathan Johnson is with us now. One of your competitors, Wayfair, did get an upgrade yesterday, and those shares were trading higher. Give us sort of a flavor for what you're seeing right now, where we are in that inventory correction cycle.
Yeah, I think it's still, retailers have lots of inventory in their warehouses. I think we'll see more promotions. 2023 feels to me like it may be a tale of two halves. A lot of promotions, a lot of inventory still getting pushed in the first half, things getting back more to normal in the second half of the year.
Do you see in the numbers that you're able to get daily that the consumer is still under stress? How much stress are they under?
Yeah, consumers are, I think they're under stress, but they're still willing to buy. What we see is that when there's a call to action with a good promotion, a special price, consumers will step up and buy. But they are minding their wallets and their purses carefully, ready to buy when the deal's there. And we think that's advantageous for Overstock because we're all about smart value, trying to please the savvy shopper.
If shoppers are looking for that promotion, then what does the future of kind of price normalization look like then? If we're talking about shoppers that are only comfortable spending at 30% discount, 40% discount, what does that mean for actual prices coming back down to those levels to really reflect where consumers are comfortable spending?
Yeah, so I think that's part of this tale of the two halves as retailers are deep in inventory, and most of that inventory, remember, is expensive inventory that came in during the supply chain challenges. I think when we get to the second half of the year, that inventory's moved out and cheaper inventory has moved in because the supply chain is running fairly smoothly now.
Is it still quality inventory though? Because that's been a question among consumers looking for the bang for their buck.
Yeah, I do think, well, I know we're flush with quality inventory, and when the second half of the year comes and less expensive inventory, is probably the better way to say it, has come in because the supply chain is normalized, I think we'll see maybe a little deflation in the prices.
Let's talk about how this affects you guys a little bit more, because Overstock is the name, but I know not all of your inventory is Overstock, so to speak. Remind me of the percentage now and whether this glut in inventory actually is beneficial for you.
Yeah, so Overstock started as a liquidator. We don't liquidate at all now. So, I mean, we're a first run, first goods, furniture and home furnishings company. We also don't own inventory. We have this vast partner supplier network that provides us inventory. That was great during the pandemic because it gave us more access to inventory. It's actually good now as they are flush with inventory, as some of our competitors have canceled their orders, have too much inventory. So we've been able to still maintain good inventory and good pricing regardless of the situation because of our asset-light business model.
When you talk to your largest investors, Jonathan, are they pushing you to get leaner on costs?
Well, yes, always, but we are very lean on cost. When you look at our revenue per employee, it runs about $1.5 million per employee. Our competitors, our best competitors, are kind of at the $800,000 per employee. So we remain lean and will continue to be that way.
I mentioned Wayfair at the beginning of the conversation. The company also announced it was cutting jobs last week and cutting some costs. Do you foresee having to cut back on costs this year and potentially cut workers?
Boy, we sure hope not. We did a small downsizing at the end of last summer, but because we run so lean, we think we've managed that. During the pandemic, when our sales surged, we did not let our overhead surge. We continue to run lean, and I think that's been helpful as we've gone forward.
How many people work for Overstock?
About 1,000, 800 plus.
That is lean.
Yeah.
All right, Jonathan, good to see you in person.
Good to be here.
Thanks for coming in the studio. Appreciate it. Jonathan Johnson is the CEO of Overstock. And we have some economic data that is just breaking here, the so-called PMI data, Purchasing Managers Index, coming to us from S&P Global. The composite PMI coming in at 46.6, which is 0.2 0.2 of a percentage point better than estimated. Services PMI also beating at 46.6 versus the 45 that economists were looking for, and manufacturing PMI at 46.8 versus the 46 that was estimated. Let's put this data in context for a moment. This is January preliminary data. So it's important because this gives us the sort of most up to the minute, the freshest look on a macro basis is what's going on in the U.S. economy. And this survey is of purchasing managers. It's of people on the ground who are putting in these purchase orders for businesses like Jonathan's, for example, and others on the services side and on the manufacturing side. So it's interesting here, you guys, that this number is indeed coming in better than estimated. You know, it's one of these numbers that cuts both ways. It's great that the number's better than estimated. What does it lead people to think about the Federal Reserve and what they're going to continue to have to do? I don't think it changes the calculus in terms of what's expected for 25 basis points increase, but it's another input to think about here.
Yeah, some more economic data coming in. Markets don't seem to be reacting too much. We were still fractionally lower for much of the morning here and still trending that direction right now. So we'll see exactly how much more this will get kind of priced into today's activity, if at all. We'll see.
Yeah, we will see. One of the other things I notice here, inflation, the rate of output charge inflation of private sector firms unchanged from what was seen in December. Input prices actually rose at a faster rate at private sector firms, although it's below what we have seen over the past couple of years. So again, some interesting various inputs here in this data that we're going to continue to watch. Coming up next, why analysts are saying investors have hit the bullseye with Target. Saz has got his take next. Bullish on Target. Oppenheimer initiated coverage this morning with an outperform rating and $190 price target. The analysts saying that they see potential for a strong multi-year profit recovery. The bullishness caught the attention of Saz. That's where we find a signal.
Right. Well, anytime you write a 75-page research report, as this was, definitely catches my attention as someone who used to write these. But let's start on Target here. The bull case for Oppenheimer on Target essentially boils down to three things. They see Target's inventory position starting to improve as the year goes along. Of course, Target was stuck with a lot of excess inventory, and they warned about that towards really last summer, and then it seemed to get worse going into the third quarter. They also see freight costs starting to cool down a bit as inflation comes off its peak. That's a good thing, not just for Target, but a lot of other retailers that ship large quantities of goods, like Walmart, you name it, Costco. Also, cost cuts boost profits. Target has started to pull back on some of their expansion initiatives, notably not necessarily the amount of store openings, but just their distribution center footprint. They were rolling that out very aggressively across the country, little distribution centers to get packages to people's houses quicker. They've started to pull back on that a little bit. Now, my guide here on when you may want to consider nibbling on Target shares, and of course, like I always mention, I'm not telling you to buy, sell, or hold any stock. This is just how I would approach thinking about Target if you are inclined to own a name like this, a consumer name like this. First, you visit a Target store, and the store doesn't feel stuffed with inventory. Sometimes in retail analysis, it could be that simple. And I think I really like what Jonathan Johnson over at Overstock just told us. It could be a tale of two years for these retailers, where they use the first half of this year to clear a lot of excess inventory, maybe warn again, reset guidance and reset expectations, and then enter the holiday season for this year in a much, much, much cleaner inventory position and show some better margins. Number two, there's a clear pivot to better consumer spending data. The consumer data right now, I would argue, is not exactly bullish on a lot of retailers, notably that skew towards the higher end consumer like Target does. Yes, they are a discounter, but they do get a higher income shopper into that store compared to a Walmart and the dollar stores. And then lastly, inflation comes closer to the Fed's 2% goal and rate hike stop. That just on paper will, or theoretically, should make it a little bit cheaper for consumers to go visit Target and stock up on their daily essentials. My take here, it's one of my favorite stores. I went to Target last weekend, coming back from the World Economic Forum here with Julie. I did my shopping. I can get it all done in one place. But the next earnings report from Target in a few weeks could be rough, and not just rough in terms of the quarter here, guys. There is a sense on the street that they might reset earnings expectations one last time, despite a series of warnings, and then maybe the street hasn't factored in another potential warning from Target in a few weeks. The other key catalyst after earnings, February 28th, Analyst Day for the company.
Yeah, some of what we can expect with Target's earnings may have already shown up in some of the retail sales data as well. When you look at some of the discretionary categories, and Target has leaned into making sure that anything in the home category or the apparel category as well, that moves in through consumers. But those were some of the more challenged categories within the most recent December report too.
Right, and Target's still one of the best run retailers in the game.
Yeah. Guys, coming up on the other side of this big tech battle, we're going to discuss which companies are set up to win this earnings season. We've got RBC Capital's Brad Erickson coming up next.
Welcome back to Yahoo Finance. I'm Brian Sazi alongside Julie Hyman and Brad Smith. Earnings madness is well underway, led by weak guidance and layoff news out of 3M. Right now, we're seeing all three major indices trade off of news like this. Dow down more than 150 points. Now, here's what's on tap this hour. Wading through the tech malaise, one top tech analyst joins us with his picks in the battered tech space. A rip in the stock price. Lululemon gets hammered with a downgrade. We have the call. And Salesforce and Disney under siege. We'll look at why activist investors are circling yet again. Brad, over to you.
All right, taking a look at the major averages here as we're 32 minutes into trade on this Tuesday. Dow Jones Industrial Average right now, that's lower by about 0.5%. Let's give you a chart look just to see what exactly is taking place here today, intraday. And you're seeing it down there on the screen by about 0.5%, as I mentioned a moment ago. Nasdaq Composite, about the same on a percentage basis here. Did touch positive territory briefly, but then retraced and is back in negative territory. S&P 500, you're seeing that down by about 0.5% as well right now, just a little bit more than that. Let's take a look at some of the major movers here on the day. We had a volatility trading pause over at the NYSE and some of those symbols there. You're taking a look at the Nasdaq 100, but just taking a look at some of the mega cap tech movers while we've got them up here on screen and teeing up our next discussion. Apple, you're seeing that hold on to gains of about 0.3% on the day. Microsoft, Google, though, they are both in negative territory. Alphabet, rather, down by about 1% right now. Amazon lower by about 1%. And then just checking in on some of those Dow components, since that would have more of those NYSE traded tickers. It was Walmart, McDonald's, Nike was also involved in that volatility trading pause. However, things have resumed trading as normal now. And so you see that reflected here on the screen as of this moment. So we'll continue to track that as we move on throughout the rest of the session. But just hopping back on over to the Nasdaq here, because this will tee up some of our next discussion as well, Julie.
Yeah, a lot of red there on the screen, not erasing, but pulling back from the strength that we have seen as of late in large cap technology. Thanks, Brad. And I know reassuring to a lot of investors that the NYSE's pricing seems to be back on track. We were just looking at tech, and Microsoft and Tesla in particular are in focus ahead of their earnings reports this week after a year of poor performance. How does Wall Street feel about the tech titans? What are investors looking for from those upcoming announcements? Yahoo Finance's Ines Ferre has the details on this. Ines, let's start with Microsoft. Tell us what people are looking for.
Yeah, and it's important to start with Microsoft because it is a barometer for cloud, for enterprise service and enterprise spending. And so let's take a look at what Wall Street is expecting for Microsoft. We have a graph for you. Microsoft is expected to report a fiscal second quarter sales increase of 2%. That would be the smallest increase in 6 years. Adjusted earnings per share are expected to come in at $2.30. That would put it ahead of almost every other S&P 500 company. But still, what this is showing you is that growth is taking a breather because earnings per share are expected to be down 7% year over year. Now, last week, Microsoft had also announced that it's cutting jobs like other tech companies. Jefferies analyst Brent Thill expecting constant currency revenue growth. That'll likely remain under pressure, lower than expected PC shipments. So don't expect anything great when it comes to PCs. We know that because the consumer is really pulling back and there was a lot of pull forward going on. And also an investor focus, though, on Azure. Now, that is the one big focus that investors, analysts are taking a look at. Microsoft just announced it's investing another $10 billion in OpenAI. That's the maker of Chat GPT, and will be integrating that with their Azure cloud service. Timothy Horn from Oppenheimer dubbing that integration of Chat GPT with Azure an iPhone moment for artificial intelligence technology. And also Wedbush's Dan Ives basically saying that Microsoft is Wedbush's favorite when it comes to a cloud theme in 2023. Dan Ives has an outperform rating, Wedbush, with a price target of $290. Look, the street is really bullish on Microsoft, even though we have seen a big slowdown in tech. Still, you've got 52 buys, 4 holds, 1 sell.
And Inez, speaking of Dan Ives, he notes this morning in a note that Tesla, their earnings call this week is probably the most important in its recent history.
Yeah, most definitely. Now, the street's still relatively bullish also on Tesla, even though the stock has really last quarter took a big beating. You've got Tesla analysts recommending 27 buys on Tesla. You also have 13 analysts with a hold and 6 with a sell. Piper Sandler putting an overweight recently on Tesla and lowering its price target from 340 to 300, saying that, look, Tesla took longer than expected to cut prices, but now that the valuations have been reset, investors should be buying Tesla. Also saying that Tesla can easily put up forth a delivery growth in 2023 of more than 50%, predicting delivery growth of anywhere between 300,000, 600,000 units just in the U.S. And gross margin forecast, even though that's been lowered by many analysts, Piper Sandler saying that they wouldn't be surprised if in 2023 they surprise to the upside. Also, Canaccord, I know that you interviewed Canaccord's George Giannakouros recently, and Canaccord also bullish on the stock. Because, look, even though the stock pulled back last year, a lot of that had to do with also many saying Elon Musk and Twitter, and also based on this demand situation in China. You still, they're highlighting the full service driving software. That's expected to increase gross margins. And also, what was very important that Canaccord highlighted was commodities came down in price. And that's something that Elon Musk has talked about, that they have been seeing a reduction, a deflation when it comes to commodities as well. So that is expected to help.
I mean, and definitely in contrast to Microsoft, the sentiment around Tesla is not as bullish, right? You talk about 52 buys for Microsoft. It's 27 in the case of Tesla, and then 13 holds and 6 sells. So there are a number who are still underperform on Tesla going into the results. Yeah,
that's right. It's not as bullish as you mentioned when it comes to Microsoft, but still out of the EV makers, you still have quite a bit of bullishness.
Yahoo Finance's own Inez Ferre, excellent breakdown there, and teeing up our next conversation perfectly here. Big tech's earnings are underway, with results expected to test the recent rebound for the sector. Here to discuss the expected winners and losers of this season's quarterly results, we've got RBC Internet analyst Brad Erickson. Brad, great to have you here with us this morning, and to get some of your insight going into the wave of earnings, the slew of earnings that are going to be coming out from some of these formerly high-growth internet names. I know we've discussed that in the past. Is this the quarter where we discover whether or not there is still high growth in the future?
No, I think it's going to be more of the same, and certainly when you think about, where numbers are going to shake out for Q4, you look at names like Meta, like Google. I mean, we're looking at year-over-year declines actually in their core businesses. So I think people are optimistic as we look towards maybe the second quarter and the second half of the year. But I think for the moment, you're going to hear a narrative of caution and headwinds, particularly as we start out 2023.
And going into 2023 here, though, Brad, your top pick is Meta. And there are a lot of dark clouds hanging over that stock, but it seems like, judging from your note, that's exactly why it is one of your top picks. I mean, is all of that priced in at this point?
Well, I mean, the stock's bounced. I think a lot of it, actually, in retrospect, we've been making this call since coming out of earnings, frankly, that we liked Meta as they look to restore a lot of that signal that they lost from the Apple software changes a year and a half ago or so. We think they are making improvements in terms of targeting and measurement, and we think that's translating to some incremental dollar growth and advertiser spend. Some of that's reflected into the print, is what I'll say. The stock has gotten a little bit more crowded, particularly in the last month or two. So the setup maybe into the print, not quite so interesting, but in general, yes, structurally, we like the fact that they are restoring that signal and think that can carry increasing tailwinds as we move through 23.
Brad, you mentioned in your note that estimates on Snap look washed out. Does that mean you buy Snap into earnings really on the thesis that it can't get any worse for this company in terms of guidance?
Yeah, so just to be clear, from a rating perspective, we are sector performed. So obviously, I got to be a little careful there. But tactically, yeah, I think Snap in particular has come out with, they announced some cost cuts a couple quarters ago, pretty substantial cost cuts into 2023. And I think as we look through street models, I think we wonder if that's totally reflected, meaning that has the potential that earnings estimates need to move up directionally from here.
Where are you seeing, and within some of the names that you say have bottom line upside potential, you're talking about Uber, the aforementioned Snap as well, DoorDash, even Meta, and the list goes on. What is it that are some of the catalysts that all of those companies are being able to really benefit from in terms of it trickling down to their bottom line?
Yeah, I mean, I think there's a couple of aspects, right? You just go through the P&L. Variable cost structures in these businesses are fairly set, so there's less you can do there. it starts with sales and marketing, right? You can cut your ad spend. Typically, we're finding that companies tend to cut more brand advertising spend because the payback period, I should say, is longer, right? They need direct response ad spend, so you can't cut as much there, but brand spend definitely got cut. And then obviously the, kind of a daily unfortunate announcement of layoffs, right? Headcount reductions. A lot of these tech companies that benefited hugely during COVID, obviously part of that was business momentum, but then part of that was they were all looking to invest in new opportunities, right? When times get a little tougher, like what we're in right now, you kind of have to pull back on some of those speculative sort of exploratory investments that some of these companies are doing. And obviously that's been translating to bottom line upside for some of these, and we think can more so here in 23.
Brad, speaking of layoffs, we had a little debate here at the top of the show about those at Alphabet in particular, and whether they're the result effectively of mismanagement and whether the layoffs themselves have been mismanaged in the way that they've been carried out. What's your take on that?
Yeah, I mean, first in terms of how the company was run, and I think what I just mentioned definitely is what's going on with Alphabet, is that their business exploded. We all know that during COVID, very self-explanatory. They had to hire more people. What's interesting, though, and I think if you read between the lines in the 8K they published around the layoffs a few days ago, is that they're working on a lot of new projects that are sort of the future of the business, i.e. maybe a competitor to something along the lines of Chat GPT you were just speaking about before this segment, right? And so the question is are these layoffs more a reflection of incremental business weakness, or are they areas that they can pull back that were sort of more speculative 3 to 5 year out type science projects? We don't know the answer. I do expect probably more clarity around that on the earnings call, but I think they're unfortunately they're trying to meet investor expectations around margins and bottom line. There was a lot of concern around that. They knew, I think they needed to do something, and that's why they pulled the trigger there.
Just kind of bringing this to a circular ending and ending on Meta, and one of the biggest impacts there continues to be the overhang with TikTok as well. TikTok is going to be making some changes reportedly to try and get more fanfare among U.S. regulators to the extent that they can woo U.S. regulators. But is that transparency push from TikTok something that Meta platforms and particularly Instagram underlying within there, does that still prove, and is that still the larger overhang risk, is that you have so many of the young consortium that still would use this platform and regulators then that may come around to allowing TikTok to just continue to operate as is or with these new mechanisms?
Yeah, I think we've taken the stance that we think the likelihood that TikTok gets banned from the App Store or whatever seems pretty low. Just all sorts of other unintended, probably adverse consequences and issues associated with that. But obviously you've seen things like, federal organizations, colleges, et cetera, removing the ability to access TikTok on their Wi-Fi networks, things like that, right? So that's sort of self-explanatory. I think the bigger issue, frankly, as an overhang for Meta's stock is just simply, it's two things. It's user engagement, and it's how well advertisers are finding value at using their platforms. And I think if you just look at latest trends, what I'd tell you is TikTok user engagement plateaued in the US about 5 or 6 months ago. And on the advertiser spend, I think what we've heard is that advertisers are sort of saturating the audience that they've spent on at relatively lower levels than Facebook, for example, or Instagram. And so there's a limit to how much you can spend. Maybe you take 5 or 10% of someone's budget, but they're not taking 40%, for example. A big bulk of it still goes to Instagram because the audience is so much bigger and the ability to scale spend there is so much bigger. We haven't heard changes there. So we're actually sort of relatively more positive on Meta versus TikTok right now, just in terms of the competitive trends we see in the market.
And Brad, out of all the tech stocks you follow, what names do you just take a step back when looking at their models, looking at their business position, that you wouldn't touch with a 10-foot pole?
Woo, that's a tough question. I think there's a lot of names in our coverage that are bottomed out, whether they were SPAC names or just in general, they've not been able to generate cash. We can argue whether those have found sort of a sentiment bottom and you get a little bit of a dead cat bounce. If you're not generating cash, if you've got heavy stock-based comp relative to your actual earnings, those, I'm not going to name names, but those would be the companies that would easily fall in the don't touch them with the 10-foot pole category.
Brad, I'll shoot you an email after this segment, but we appreciate you and we appreciate that answer. RBC Internet analyst Brad Erickson, we'll talk to you soon. Appreciate seeing you. All right, speaking of tech, Intel may deliver another negative earnings surprise when it reports fourth quarter results and guidance on Thursday, according to Citi analyst Chris Danley. Says Danley, we expect Intel to guide below the normal seasonal range for the first quarter revenue and EPS, given continued weakness in the PC and data center markets. I have more on this call now on the Yahoo Finance homepage, so check it out. Coming up, Amazon is diving deeper into the healthcare space. Julie will discuss that, plus have more top headlines you need to know next.
Let's get to some other top stories that we are following for you today. Some other headlines. The U.S. Justice Department reportedly looking to slap Alphabet's Google with an antitrust lawsuit over its dominance in the digital advertising market. The case is expected to be filed in federal court before the end of the week. And this would mark the second antitrust case against the tech giant. Google already faces a DOJ lawsuit taking aim at the company's search practices. Bloomberg reporting the news of that expected filing. The Twitter troubles continue as the social media giant faces a lawsuit with claims from landlords regarding unpaid rent. Twitter's San Francisco headquarters faces the accusation from its landlord of not paying a total of nearly $7 million in rent for December and January. Those same troubles can be found overseas. The landlord of Twitter's offices in central London suing the social media company for allegedly not paying backdated rent there. That amount has not been disclosed. And Amazon is strengthening its healthcare push with the launch of its RX Pass subscription service, available for U.S. Prime members. Customers will pay a $5 monthly subscription plan to access and obtain discounts on over 50 medications that treat more than 80 common health conditions. However, customers enrolled in Medicare, Medicaid, or any other government healthcare program will not be eligible for this service. Saws Amazon pushing further into healthcare with this new initiative.
Indeed, they are. All right. Award season is back in session, and the nominations are out for the 2023 Academy Awards. Yahoo Finance media reporter Ali Cannell is here. Ali, so what are some of these nominations, and how is streaming represented?
Well, I say last year it was all about Apple, right, with Coda. This year, I think the story is Netflix. Netflix dominated the nominations this year, earning 16 total nods, the most out of any streaming service, and it was led by the German film All Quiet on the Western Front. That movie securing 9 total nods to land in the top 3 most nominated films, tied with Searchlight Pictures' Banshees of Inisherin, and just behind A24's Everything Everywhere All at Once, which scored 11 nominations. And I think this shows the increased diversity within the Academy. A lot of love for international films, a lot of love for international actors and actresses. We could maybe even see a Parasite moment repeated with All Quiet on the Western Front, potentially winning Best Picture along with Best International Film. So that will be one to watch, and certainly a big one for Netflix. But if we shift gears to Disney, Marvel getting a lot of Oscar attention with Black Panther, Wakanda Forever. Although the film was shut out from the Best Picture category, Angela Bassett earning a Best Supporting Actress nomination, and she made history on several fronts. She's the first woman, the first person of color, and the first Marvel Studios actor to be nominated for a performance in a comic book adaptation. So huge momentum shift there for Disney. But overall, there was a very wide mix of films nominated this year, from the big studios to the streamers to the indies, and some big blockbusters recognized as well, with Avatar: The Way of Water, Top Gun: Maverick, Black Panther, as we mentioned. And normally we don't get a chance to see that. But from the streaming side of things, I think Netflix was a standout for me.
Yeah, it's going to be interesting to watch, see if Angela Bassett could add on to the trophy shelf as well, already getting a Golden Globe for her performance in Wakanda Forever. What do these awards typically mean for the investors out there that are tracking which production house, which streaming platform is able to bring home not just a nomination, but a win for some of their productions as well?
And look, this has been long debated. Do these awards matter anymore? But I do think there is a level of prestige. If you are nominated, along if you potentially win, we know there's been confirmed box office bumps if a film not only is nominated, but especially if they go to win this award. Best Picture, usually the most watched category there. I think in the streaming era, there's been some debate on how that's affected things, since it's a little bit harder to determine that versus box office dollars. But I think especially for streamers looking to just be taken more seriously within Hollywood, I think if they can win some of these awards, it's a huge thing for the industry. And just another thing I want to point out is Rihanna is going to be performing at the Oscars, because her song was nominated for Black Panther: Wakanda Forever, Lift Me Up. And I just want to say that Rihanna is also performing in the Super Bowl, and we haven't seen her perform in quite a few years. So now within a month, we have 2 big performances there. She's going up against Lady Gaga. So I think on the music side of things, that's exciting as well.
Yeah, she's been busy.
Oh, very busy. She has a baby, the whole shebang.
Baby, business, she's a boss.
Exactly.
All right, thanks so much, Ali. Coming up, why activist investors are reportedly flocking to Salesforce. We'll speak with a Boston College professor about what activists tend to do for companies and for their stocks. With stocks dropping last year, activists stepped in to try to juice performance. Asset management firm Lazard saw a 39% increase in activist campaigns over the past year. And then, of course, just over the past few days, we've heard about an uptick in activist activity at Salesforce. Let's talk more about this phenomenon. We're joined now by Slava Foss. He is Boston College Professor of Finance and Hillenbrand Family Faculty Fellow. Thank you for being here, Professor. Appreciate it. In your research, when you have looked at activist campaigns, have they helped in terms of the stock price? And sort of, are you able to draw that direct connection between the activist campaign and the stock performance?
Yes, hello. It's very my pleasure to join the show. My research, as well as other researchers, have shown a very robust relationship between activist campaigns and valuation of companies. We know that when activist campaigns are announced, typically prices go up. It means that market participants like when activists target companies. And here we have in mind shareholders and all other participants who look at companies and try to forecast how well these companies will be doing in the future.
What types of defenses could a Disney or Salesforce, what might we see from them? We've seen Disney come out here a little aggressively with the rhetoric, but Salesforce really has done nothing. What might we see from these companies?
Well, public aspect of defense is one thing, and maybe this is why we don't see many things happening. Typically, a lot of things are happening behind the scenes. This is where management and activists do negotiations, and they try to come up with idea of maybe representation for activists on boards of these companies. If such activist engagement leads to proxy contest, where actually there is contested election of board members, and we know that there are well-known tools that companies can use. For example, some companies impose voting restrictions, and they can say that we'll need supermajority of shareholders to vote for candidates. And of course, companies can use their own resources to engage in public fight with activist shareholders.
There are now three big-name activist investors in Salesforce. Have you seen something like that before in the past? And what does that say about the fundamentals of a company like that?
Typically, one of key drivers of companies being targeted in activist campaign is valuation. We know that when companies experience negative stock market performance, they're more likely to be targeted by activists. That is probably what is common across many targets of activist campaigns. Now, the fact that three big companies are targets of activists, it reflects the fact that probably there is a larger degree of consensus between shareholders that these companies need to change. These companies need to change something in the way they're doing, in the way they are taking care of their financials.
Salesforce is, if you're looking at some of the all-time highs that they had back in late 2021, they're about 48%, at least the share price is, off of those levels. What is the likelihood, based on past instances, that these activist campaigns will actually lead to the share price or the business performance reflecting that share price or getting back to some of those all-time highs? Has that been something that's been effective in the past?
Absolutely, it has been. Now, it's hard to say in any specific situation what will happen, but we know that on average, when activism campaigns are announced, prices appreciate by 5-6 percentage points just on the announcement day, which is a very nice increase in valuation, and it creates a lot of value for shareholders. Now, in my own research, I have shown that this positive price reaction indeed reflects anticipation of future improvements in these companies. In fact, about 75% of positive price reaction can be directly linked to future improvements in operating performance of these firms. So it's definitely good news for companies. It's definitely good news for shareholders of these firms.
Professor, have we seen any big changes in activist campaigns over the past several decades? Have we seen an increase in their number, for example, or a difference in the tactics that they use?
The number of activism campaigns is stable. I would say that recently more and more we see larger targets experiencing activism campaigns. And I think it reflects probably a larger degree of coordination on the side of activists. They probably feel that other investors are willing to support them, and therefore they go ahead even after very big targets.
Boston College professor of finance, Slava Foss, joining us this morning. Thanks so much for the time, the insights, the analysis as well. Appreciate it. Coming up, 3 things you need to know about Chat GPT. Dan Halley's got the breakdown next. Rise of the robots. Microsoft is betting big on AI with its multi-billion-dollar investment in Chat GPT. But what is it? Yahoo Finance's Dan Halley joins us now for a breakdown. All right, hit us with the vibes of Chat GPT. Dan.
The vibes indeed. So Chat GPT is an AI-powered chatbot. Basically, it provides you with human-sounding answers to different queries, and you can actually ask it a number of different types of queries. I asked it yesterday how to make a meatloaf. It's not going to be as good as my mom's, but it was a decent recipe. Or you can ask it to do things like come up with random stories. I asked it to make up a story about a maniac barber who eats human hair, and it did just that. It can also answer follow-up questions. So if you ask, what is the Bible? How long is it? It can provide you with some of those answers. It's actually developed by a company called OpenAI, and it's only one of a number of artificial intelligence initiatives that they have going. It was founded in 2015 by a number of researchers. That includes former Stripe CTO Greg Brockman. He currently serves as president, and the current CEO is Sam Altman. He's the former president of Y Combinator. Part of getting that off the ground, though, included a number of investors, including the likes of Elon Musk, Peter Thiel, and AWS. They all committed an initial $1 billion to get this research going. In 2019, though, Microsoft came in and provided another $1 billion investment. So they had already been in there. They also, at that point, became the exclusive computing partner for OpenAI. So they have that edge in there already, in addition to this new $10 billion investment. Musk, who I mentioned was one of those initial investors, actually stepped away from the company in 2018. He was also a co-chair for the company because he had been critical of the company and the way it had been operating. He doesn't think that it's being open enough, despite their name OpenAI and the fact that they're a nonprofit. So then what are the risks for something like Chat GPT? Well, the software can be inaccurate and it can provide answers that are wholeheartedly incorrect. You can ask it certain answers and it'll provide them and they'll just be flat out wrong. And that's just because of the way it's trained. There are people who go in and look at some of these queries to determine whether they're correct or not, and they try to correct it. But there's only so many people can do on such a large platform. The other issue is that ChatGPT was only trained on data from 2021 and before. So if you ask it events that have happened in 2022 or 2023, it's just not going to know that. It's not connected to the web. The information from 2021 and prior was pulled down and then it was trained on that. So it's not like you can ask it what the weather's going to be or who won the games on Saturday and Sunday in football. And the other thing is that there's fears that it could start to push people out of jobs that otherwise they would be able to perform without issue. So think things like writing, for instance, or some kinds of secretarial work. There's fears that ChatGPT, if it continues to develop, could simply take over those roles. And the other issue, and this is something that Musk had brought up, was this was initially a nonprofit company. Now it's a profit-capped company where they're only allowed to reach a certain level of revenue, and then the rest of that goes into nonprofits. So there's this kind of change in how the company has been run over time that's kind of raising some concerns, but obviously not a big issue for Microsoft with that $10 billion investment.
And Dan, you would have to think that this Chat GPT will also disrupt Microsoft's own products, right?
Yeah, so the big thing for Microsoft here is that this could give it an edge over the likes of Google and Amazon, as well as Salesforce, frankly. Microsoft competes with Salesforce in the enterprise. If they add capabilities like what ChatGPT is capable of, then it could provide a better overall experience for enterprise customers. As far as Google, it could add the capabilities that you would want in a search engine like Bing. Now, as I said, this is not built for search engines, but the capability to respond to people in a human-like manner, that's something that we could see added to Bing. Look, Google makes up 90-something% of search engine marketplace in the world. I don't know if Bing's going to eclipse that with just one addition, but it could give them a leg up. And then as far as Amazon goes, if they add these capabilities to Azure, it could make that platform all the more appealing to customers. Amazon's the #1 cloud provider in the world. Microsoft's Azure is #2. If Microsoft can really get the edge here, then it could start to muscle out Amazon. So there are huge benefits to Microsoft with this $10 billion investment. And as I spoke to some analysts yesterday, they basically said, look, they made this $10 billion investment after laying off thousands of people. It shows how important this investment is to them then.
Yahoo Finance's Dan Halley with the analysis. Appreciate it. Coming up, crypto chaos, why our next guest isn't giving up on his push to go public despite the collapse of crypto. We'll discuss that next. A cold climate for crypto isn't putting off blockchain startup Chia from its plans to go public. The company, which says its proof of space blockchain method is more eco-friendly, recently appointed a new CEO and has signaled plans to go public next year. Gene Hoffman is that new CEO and joins us now. Gene, welcome to Yahoo Finance. Just given the fallout with FTX, Genesis, you name it, why should investors trust you and trust your company?
Well, I think investors made a mistake of considering crypto to be an asset class. It's a set of rivalrous technologies. And we've invented a much better blockchain. We have the kind of security of Bitcoin with 800 times less annual energy use and the sophistication Ethereum promises, but doesn't deliver very well. As we see a lot of hacks on the Ethereum blockchain due to Solidity vulnerabilities, this is the programming environment, Ethereum, we went and invented Chia List, which is a much better way to do that. And what that's led to is real world adoption. Blockchains should be driving real world applications. And so one of the first things that's going to be going on the Chia blockchain is the climate action data trust and the voluntary carbon markets under Article 6 of the Paris Agreement. The World Bank, the government of Singapore, and IXIC are running the climate action data trust. And this will be a trust enhancing data set of all of the carbon registries. So you'll get a meta registry of carbon. And then the IFC has partnered with us to start issuing high quality carbon on the Chia blockchain for retirement and onward sale. So it's these kinds of real world applications that a better set of technologies can enable. In many ways, like the FTX situation was, blockchains were invented to stop having centralized parties that you have to trust.
And Gene, the last we saw from your company had a valuation of $500 million. What is your valuation today, and how much in profits will you make this year?
Well, we haven't really had a recent revaluation. We have about $1 billion worth of coins on our balance sheet in our pre-farm. We are early in our revenue growth, but it is growing significantly with these big partners in the carbon markets, also commercial banks. We're also partnering with other governments for other interesting projects around the world. So, we've really finally delivered a blockchain that governments and industries can use, as well as.
So, Gene, just to make sure, as investors start to think about your company being public, you're not making money right now.
We aren't profitable yet. We are increasing revenue. But the thing is the company itself also derives indirect value by holding our own coin. So as our adoption increases, the desire to use coins to actually access our network increases the value of those coins. And so investors make enhancements both ways, both in the balance sheet and therefore their claim on the balance sheet and revenue.
And sorry, Gene, what is the source of your revenue? How exactly, sorry to get, to drill in here, but what the partnerships that you're talking about, what's the transfer mechanism of how you guys make money?
We're very much like Red Hat or MySQL, where large enterprises who are adopting blockchain technology to tokenize assets, to build markets, are having us come in. We do integration fees with them to build a project, and then we have ongoing support and maintenance fees, as well as generally a piece of the number of coins they issue or the wallets that they actually finally address. So we kind of scale with them as they grow. And then indirectly, as they put volume on the Chia blockchain, it drives demand for Chia, and that's kind of the underpinning value, if you will, of Chia. And we happen to have quite a bit of that, and are going to long-term distribute that to the shareholders as dividends.
How many clients or what type of spend profile among clients do you model for in order to reach profitability?
Well, so we kind of have three kind of core customer sizes. There's one in the kind of, call it, $1 million to $2 million up front, and kind of $500,000 to $1 million ongoing. And these are things like commercial banks, folks like some of the carbon registries and the partners that actually drive carbon markets. Then there's kind of a mid-sized group of $500,000 up front and $250,000 annually. And you certainly have some smaller folks who are in the $1,500,000 with $50,000 to $25,000 annually.
And Gene, how many investors do you have in the company, and who are the top five?
The major investors are A16Z, Richmond Global Ventures, Slow, True, Naval, kind of a who's who in the Silicon Valley crypto world and the general venture world. Probably about 40 investors total, but that includes some smaller folks.
Gene, I know you recently told another news outlet that you still would be interested in going public in this environment. At the same time, there was a story in the Wall Street Journal today saying the Securities and Exchange Commission is very closely scrutinizing anything with a whiff of crypto that wants to go public, whether through a SPAC, through initial public offering, what have you. So what's the timeline here, and what's the real likelihood that you guys are going to be able to come to public markets?
Well, first of all, we think that the securities regulation in the United States are actually relatively simple. And unlike a lot of other projects, we're a software company that has never sold our coins for an investment of money. It's much easier to not be a security and then actually have real securities sold to real investors the right way. We've had a long-term engagement with the SEC. This is not our first time talking to them, and they generally have been supportive of our plans. And so our view is that we want to get on file. We're absolutely, realistic that the external market forces look weird right now, but we actually believe that the SEC is relatively supportive of our model of actually filing a registration statement and selling equity and keeping our coin in the, classic commodity status regulated by the CFTC.
Gene, given the climate action data trust prioritization for Chia Network, that kind of gives a nod to one of the biggest risks that many people have talked about within not just blockchain, but specifically cryptocurrency. Do you believe that crypto can scale to mass adoption without becoming a climate risk in the future?
Absolutely. Right now, Bitcoin is the only really other secure blockchain. Proof of stake is just not capable of being secure against governments and industries. So we invented proof of space and time to really directly address the energy use problem in Bitcoin. So on an annualized basis, for the same or even better security than Bitcoin, we use about 800 times less electricity. And that's only going to get better as the world shifts from hard drives to solid state drives, which don't spin. So we've got another kind of order of 10 in decrease in electrical use to secure our network. So one of the reasons why the Climate Action Data Trust could adopt the Chia blockchain was because it gave those security guarantees at such a much more efficient level.
Gene Hoffman, Chia Network CEO and President. Gene, we appreciate the time here today and taking some of our questions.
Thank you.
All right, guys, and coming up, Bernstein is warning of a reset to come for Lululemon. We're going to share the details next. Welcome back, everyone. Time Time for cover time. 3 stories, 1 minute each. Let's start with this on the day. Bernstein is warning of trouble ahead for Lululemon, downgrading the apparel maker from market perform to underperform and saying the expectation versus the reality gap is the biggest concern there. And this one from friend of the show, Anisha Sherman, excuse me. We've made it to the end of the show this far. But she had mentioned that after delivering 25% sales growth, 30+% earnings growth for 5 straight years, they've got a reset coming. And so we'll see if that proves to be the case when they report earnings next.
I bet you love this call, Brian.
I do. It just cuts through all the BS out there. A lot of analysts, I think, are just dancing around the fact that this company is going to see sharply slowing growth this year, likely. And Anisha's right on point here. Our Josh Schaefer actually has more on this call now on the Yahoo Finance homepage. Check it out. But Anisha's saying there is a reality check coming to Wall Street, and I'm feeling it. I think this makes sense.
Yeah, and we have the D.D. Thomas shopping indicator as well. She walked into one of our folks here who talked to us about Beth and Beyond and her shopping there. She walked into a Lululemon in Dallas, Texas. There were no discounts. She walked right out.
Walk right out. All right, from that to tech, Bernstein is also turning bearish on AMD, downgrading the chip maker from outperform to market perform. This comes after the company got a boost yesterday on an upgrade from Barclays. So differing opinions here on AMD. Yesterday stock up, today stock down. But what they're saying here is that AMD perhaps maybe caught up in the aggressive discounting over at Intel. Intel, of course, uncorking potential discounts to drive demand in what has been a challenging period for them.
Yeah, and that's going to be problematic for gross margins.
Yeah, Barclays, we've heard a lot in the chip space this week, especially given what Barclays had said, and around semiconductors, particularly given the move lower that you'd seen over 2022. There's going to be a lot of nibbling, or at least in the future, some of the perhaps tailwinds that they could ride on, one of them being internationally in China. That was cited by Barclays, but for Bernstein, and this downgrade for AMD. Within the falling demand profile, I guess it's just what categories they would see that demand falling, because now you look across all of the different consumer goods that would be produced and where that demand would stay lower for longer, and what that would signal for AMD as well.
We get earnings from them next week.
Yeah.
Halliburton is reporting fourth quarter profit that beat expectations. It also raised its dividend by 33%. CEO Jeff Miller says he expects earnings to strengthen in 2023 and beyond. The shares are trading lower, though, and I'm actually not entirely sure why. The company's earnings beat estimates here. They had that dividend increase. They bought back stock. They did see sales in North America fall by 1%. Because they had some weather delays that affected fracking work done by the company. So maybe that is what is going on in Halliburton. But a lot of the folks we've talked to, you guys, say that they still like energy stocks in 2023.
Yeah, it is interesting to see this reaction. All these energy stocks had very strong moves last year. Perhaps more we'll see sell the news type events as we get more earnings results.
Yeah, and for the company, international continued to remain strong, at least. That was up 9% compared to the third quarter of 2022. And then Latin America, that had an increase sequentially of 12% here. But yeah, just commenting on what the president and CEO said in this recent quarter, the operating divisions still delivering strong margins, international and North America.
Halliburton shares, by the way, I'm going to sneak in one more thing, up 72% last year.
Wow.
So when you talk about sell the news, it's,
Got that from Yahoo Finance, right?
Yeah.
A stock chart? Yes?
Yeah.
Okay.
Coming up, Rochelle Akufo will do a deeper dive into those GE earnings with an analyst from Bank of America. Keep it right here.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Earnings coming in hot. We've got results from General Electric and 3M, with 3M announcing job cuts as demand for products fell apart at the end of last year. We'll break it all down in just a few moments. Plus, Union Pacific misses earnings estimates. The company hit by challenges in hiring, inflation, and extreme winter weather. We'll get a pulse on where things stand with CEO Lance Fritz. And Tesla's battered stock is looking like a buy again. We'll break down why the company is still Wall Street's favorite EV company ahead of a big earnings report this week. But first, let's check in and see how the major indices are doing. We see it's a mixed picture at the moment. The Dow, they're just barely in positive territory, up about 15 points. The S&P, they're down about 0.1%. And the tech-heavy Nasdaq, same territory, they're down 0.1% as we're sort of digesting all these earnings that are coming in. Let's also take a look at what's happening with the Treasury market as well, as we see with some of these shorter-term yields as well as the long-term, all three in negative territory. The 5-year down just about 3 points there, the 10-year down about just over 1%, and the 30-year long-term yields there down 1.3% on the day. All right, now let's get to Yahoo Finance's Ines Ferrer with some of today's biggest market movers. Hey, Ines.
Hey, Rochelle, and let's start with the Dow, because we have been watching on the Dow 3M down more than 5%. And this is after 3M reported its quarterly results, with 3M disappointing when it comes to its profit outlook for 2023. It had an earnings miss. The company also announcing that it will be cutting about 2,500 manufacturing jobs. Why is this company important? Well, this company makes everything from building materials to materials for the medical industry, even cleaning supplies. Right now, you're watching the stock that's lower after its quarterly results. I'm going to pull up a year-to-date chart so you can see it's down about 3% year-to-date. Over on the Nasdaq 100, I'm keeping an eye out on one stock in particular here, and that's AMD, down more than 2.5%, or down about 2.5%. This is after Bernstein cut AMD to market perform, cut its price target to $80 per share. AMD will be announcing its quarterly results on January 31st next week. And the chip space has really been going through an interesting time, so to speak. You have had chip companies talking about falling prices when it comes to the chips. And then taking a look at the sectors, I am keeping an eye on what's happening with the energy sector, because we are seeing this lagging today. And particularly, one stock in particular that I am also keeping an eye on is Halliburton. This is after it reported its results, with Halliburton reporting a fourth quarter profit beat, also raising its dividend by 33%. Again, today we are seeing energy stocks pull back a bit. They did very well last year. Year to date, XLE, by the way, is up about 2.5%, Rochelle.
All right, thanks for that market update there, Ines Ferrer. Well, Union Pacific also out, but with a miss on estimates in its latest quarter, with higher expenses associated with inflation and network recovery weighing on revenue growth. The guidance for 2023 providing some light at the end of the tunnel, with full-year operating ratio expecting to improve and carloads to exceed industrial production. Well, here with further insights is Union Pacific CEO Lance Fritz. Lance, good to have you on the show. So I first want to ask you about this, because we were looking at the revenue growth, but then we saw what it's been offset by some of these challenges, including operation inefficiencies, elevated operating expenses. What is the plan here to really turn that around and cut some of these costs?
Yeah, Rochelle, well, first, thank you for hosting me. And also, thank you for recognizing that we did grow last year. We beat our markets, if you will, both in the fourth quarter and in the full year. And it generated positive revenue, record revenue. But to your point, what are we going to do to recover the productivity and generate improved margins going into next year? First and foremost, it's about making sure that we have crew availability where we need it. Our hiring pipeline is fully charged, and we're graduating about 150 to 200 conductors a month right now. That's the high pace that we exited the year last year. So that gives us confidence we're going to get the resources right. The current network is fluid. We exited last year and are currently performing at a car velocity and a trip plan compliance for our customers that indicates we're a pretty fluid railroad. Now, we're an outdoor network, so we're going to be impacted by things like Winter Storm Elliott at the tail end of December and other things that'll occur throughout the year. But with our capital investment, with getting the resources right, and with a very agile and better operating performance, we're confident we're going to get margin improvement in the year.
And obviously, there are a lot of macroeconomic issues weighing on all companies. But as you mentioned, things like winter weather, more specific to your industry, but also some tightness in the labor market. Tell us about the hiring picture and now how that's impacting business.
Yeah, the hiring picture was very difficult through last year, and specifically in areas where we operate in a rural environment where the workforce is small and the unemployment rate are very low. That's areas like in the middle of Iowa, in the middle and western Nebraska, out into Wyoming, and even up into Minnesota. Those areas we've largely been able to hire recently and fill our classes. But through last year, we were having a heck of a time. Now we're doing things like paying a $25,000 hiring bonus in certain spots. We're adjusting other aspects of the job. We've made sure our training produces a conductor that's fully capable and ready to work. And we've got a wonderful referral program where we ask our employees to refer people they know, because great people know great people. And out of about 12,000 plus referrals last year, we generated over 1,200 job offers. So that's a heck of a way for us to fill our classes as well.
And certainly helps in a very tight labor market. I do want to look at another bright note in your earnings data there, the operating ratios, which is a measure of efficiency, hitting 61%. Now, obviously, this is above the 60% threshold that a lot of railroad companies were trying to get to since the pandemic. What do you attribute that to? And I know that that's something that you also plan to see improvement in this year, in the rest of this year. How do you plan to get there?
Yeah, so Rochelle, if you go back a handful of years, we implemented an operating system that's code word PSR, precision scheduled railroading in the industry. What it fundamentally means is we redesigned our network to take work out of the network that didn't need to happen. We were switching cars in areas they didn't need to be, and we were running trains at relatively small train lengths and more of them than we needed on the network. By doing that, we fundamentally lowered our cost structure, which improved our operating ratio. At this point, a big step like that really isn't available. At this point, it's blocking and tackling, using locomotives more efficiently, being fluid, making sure crew availability is high so we can use our crews efficiently, and continuing to look for opportunities to keep adding cars to existing train networks, which is a very productive way to grow.
And Lance, I know you've been pushing for more innovation, and we know that you joined forces with the Rail Pulse Coalition. What does that mean for how you grow the business from here, what the industry means, and even in terms of perhaps crew size?
Yeah, so Rochelle, Rail Pulse is a good example of some of the technology investments that we're making. That's a consortium of other car owners. They can be railroads, they can be customers. And in that consortium, we've committed to GPS up the rail cars. Rail cars are interesting in that they are on a fixed asset, the rail network. So largely you know where they are. But when you start interchanging them or sending them into short lines, that visibility gets reduced pretty dramatically. And by putting technology on the rail car, we'll increase that visibility. There's other investments we're making, like modeling systems to know how to build a T-plan that's more robust, making customer experience better, whether it's dray drivers on one of our intermodal ramps or customers getting an improved estimated time of arrival, and even the fundamental technology that runs the network, something we call net control, and the computer-aided dispatch. All of those are seeing investments and improvements, and they help us run a more fluid and more consistent, reliable network.
Now, Lance, something that a lot of analysts were also honing in on is the regulatory environment with the Surface Transportation Board, which is the economic regulator for your business. Some potential changes ahead might make it easier for customers to bring cases. What do you say to investors who are perhaps worried about how this might potentially change the operating environment?
So the STB is our primary commercial regulator, and they are active. We've been spending a lot of time with STB members and their staffs, helping them see the rail economy from our perspective and in the light of the kind of regulations that they're thinking about. Generally speaking, the STB wants to get it right. They appreciate that their job is to ensure that the U.S. freight rail network supports growth, supports customers, and is able to reinvest in itself. So bottom line, they have a vested interest in making sure their decisions are done well. And we just help them see, from our perspective, how that impacts the design of some of the regulations that they're contemplating. So far, so good. They've done a very good job of balancing what they think needs to happen with doing it in a way that maintains the health of the freight rail network.
Well, I do appreciate you joining me this morning. Union Pacific CEO Lance Fritz, thank you so much.
Thank you, Rochelle.
All right, well, Microsoft earnings set to kick off tech earnings this week as layoffs sweep throughout the industry. With Microsoft among the tech giants with the largest job cuts, could this be a sign of what's to come? We're here to break it all down is Yahoo Finance's Dan Howley. So Dan, a lot of expectations people are looking at here.
That's right, Rochelle. This is the first earnings, obviously, since Microsoft announced that it was cutting 10,000 jobs across a number of different businesses. And so this particular earnings call is likely going to be one where CEO Satya Nadella is peppered with questions regarding the decision behind those layoffs. And then, oh, yes, they just invested $10 billion in OpenAI for that Chat GPT action. So, there's a lot going on at Microsoft. But just to break down some of the numbers here, according to analysts on the street, are expecting $52.9 billion this quarter. That's up from 51.7 in the prior quarter last year, but only by about a little more than 2%. So you can see that growth is slowing here. We're also looking at $2.30 for EPS. That's down from $2.48 in Q2 last year. Business and productivity and business processes, that's stuff like Office and things along those lines. That's going to be $16.8 billion expected, up from $15.9 billion. This is where things start to get a little cloudier, no pun intended. The intelligent cloud is going to be $21.4 billion expected. That's up from $18.3 billion. The problem is that growth is slowing significantly there. What we're looking at is a potential 16.9% year-over-year growth there. That's down from the 26% growth we had seen in the same quarter last year. And then finally, we have more personal computing. This is where you get Windows sales, things like that. That's going to be expected to come in at $14.7 billion. That's down from $17.4 billion in the prior quarter. So obviously, this narrative of Microsoft struggling with slowing PC sales and slowing cloud sales is holding true as far as these earnings go, especially with these layoffs and then that huge investment in OpenAI and Chat GPT. This is going to be a very interesting call for Satya Nadella and company.
Indeed, especially in light of the layoffs as well, trying to make those cost-cutting measures work. A big thank you there for Dan Howley. All right, coming up, Elon Musk continues to be the face of Tesla's turmoil, but are the bulls back on the EV maker ahead of tomorrow's earnings? And is now the time to buy? We'll discuss next. Despite companies so far largely beating expectations for the fourth quarter, the softening S&P 500 earnings backdrop still spells trouble for stocks, according to a recent RBC Capital Markets report. Where may investors be looking to, and where may the market be headed? We're here to discuss is Neil Shah, Edison Group Director of Research. Good to see you, Neil. So, as we're seeing here, I mean, this is a better Q4 earnings season so far, as you said in your note, than you expected. But what do you attribute that to?
I think that the consumer has been more robust than a lot of people feared, particularly around the holiday season, and it varies by region. So you're seeing signs that actually Europe has fared a lot better than perhaps the US has. And last time I was on the show, I think there was a lot of nervousness about how Q4 ended. We've come into January, a lot of companies reporting actually positive trading updates, and I think that that's being reflected in a buoyant market that we're seeing today.
And Neil, you are saying that we're currently in a sweet spot between easing inflationary pressures and corporate earnings potentially deteriorating. So then how should investors approach this period?
But it's tricky. I mean, I think this year is going to be a tricky year for investors. I was reading one investment house's note, and their assessment was that the portfolio you want for the next 6 to 9 months is very different to the portfolio you want for a decade of investing. And you've got to make up your mind how long-term you want to be in your positioning. Right now, what we're seeing is that all the sectors that kicked you in 2022, have been kissing you in 2023. Whether you want to be in those stocks long-term, I think is a big question mark. So we've seen a rotation out of, for example, consumer staples into consumer discretionary. There might be some good reasons for that. We can talk about some of the themes we're looking at. But I think that you need to be reasonably nimble as we are in this market. You can participate in the market, and I think you want to be rotating in and out of sectors.
And Neil, speaking of those key themes that you're going to be watching this year, baby boomers' wealth, geopolitical tensions, industrial automation, natural resources, and oil, which one do you think has, I guess, the most propensity to do the most damage to markets or to really shift the narrative this year?
I think look, there's my view is that the winners of the last decade will be are different to the winners of the next decade. And I think we're seeing a pivot in the market. We started to see that rotation out of long duration growth stocks as rates started going up into old school economy names, particularly companies with real assets, cash flowing businesses, people looking for dividend yields, and old school industrial names where the valuations were slightly more attractive. Now, looking forward, some of the things that I would look to play are that I think that you're going to find upside surprises in certain sectors. So let's touch on this idea of you've seen actually consumer discretionary, particularly in Europe, outpace consumer staples. One of the things that we're starting to see is that the baby boomer generation, who is coming up for retirement, and there's a massive pool of wealth, is not necessarily passing it on to the next generation. I think this COVID impact has meant that people are looking to treat themselves, spoil themselves a little bit, and you're starting to see them spend on some of the top performing sectors. So travel, leisure has done reasonably well. And that's a theme that I think you can start to, you may look to play. I think it's early days, so you want to see some points validating that. But luxury goods, for instance, is an area where I think there's quite a lot of interest. I also think that the geopolitical environment is one which is going to persist. We've got this situation in Russia. China's coming out of its lockdown, but I think that's going to remain an issue for the markets over the next 12 months. And one of the things I think policymakers are going to be focusing on more than ever is energy security. And one of the things we're looking to play is the switch of energy from east to west to actually north to south. So the fields, the energy fields in Africa and Northern Europe start to take much more of a sort of strategic importance. And we're starting to look for points of value in companies operating in these areas. So I think it's very much the nature of what I'm discussing is it's a stock picker's market. You need to find interesting long-term themes that are going to contribute to growth that outpaces inflation, that offsets a depressed demand environment. And it's worth participating in the market, but I don't think that you could just buy a general ETF. I think you'll struggle if you do that. I think you need to find interesting plays in the market.
So it sounds like a more targeted approach, as you're mentioning there. And I want to talk about a trend that you mentioned, because you're talking about this orderly deflation of assets that we're going to see. We saw it last year with tech and some of these longer duration ones. But this year, you're expecting private equity and real estate to be more in focus. How do you see that unfolding?
I mean, it's the Warren Buffett thing of, when the tide goes out, you'll see who's swimming naked. It is, a lot of private equity firms, for instance, will have invested in things. Those where, they've invested using financial engineering are likely to be caught out because it's getting more costly to borrow. And I think that, the possibility of write-downs is there. Those who do the harder thing of actually improving the assets that they're investing in potentially stand a chance. So I think that the private equity sector is going to see some pressure in terms of the values it's holding of its holdings, etc. Are you going to see write-downs? And a lot of the focus this year is going to be on that sector. And I think it's going to be a slightly more challenging environment. Real estate is in a similar kind of situation. Rates are going up. You're already starting to see weakness in the housing market, but I think you're going to start to see that more broadly in the commercial real estate sector. And again, I'd focus on, are you going to start to see the possibility of some write-downs in that sector? The main thing I'd focus on is that it's not panic. I think it's an orderly adjustment of valuations to a new environment. And I would, for the reasons I've set out, I'd be cautious about those two sectors because I think those are going to come into focus this year.
Everyone certainly has to do their homework in this environment. A big thank you there to Neil Shah, Edison Group Director of Research. Thank you for your time this morning. Well, it's no secret that Tesla had a rough year facing production delays in China and, of course, Musk's Twitter backlash. However, that doesn't seem to deter analysts who follow the EV giant, with Wall Street seeing Tesla as a buy ahead of earnings. Well, here with the details is Yahoo Finance's Pras Subramanian. Pras, it's hard for people not to be bullish on Tesla for some reason.
Yeah, Rochelle, there's always a lot of excitement for that stock, but just turning to sort of the stock performance of last year, it's just down so much that for analysts, they kind of just see upside from here. We've been tracking some of these numbers. 57% of analysts, according to Bloomberg, have a buy rating on the stock right now ahead of earnings tomorrow night. So we talk about this possible bounce back here. We've seen the shares kind of move up higher already in 2023. But beyond the rating, what's more important for analysts here are things like gross margins, right? You have analysts like Tony Sacconaghi at Bernstein who are concerned about margins shrinking because of those price cuts, which happened in Q1. So we won't see that reflection in Q4, but might hear about it in terms of guidance. Other analysts like Canaccord's George Gianrikas, who you guys had on yesterday, talking about how margins aren't that important because it's actually all about sort of growing their market share. And they can do that because they can cut prices and also use kind of the cheaper component prices that they've been seeing recently, and also sell high margin products like FSD or full self-driving that will allow them to sort of recoup some of that margin. Also, another thing to watch is, of course, volume and deliveries. Tesla has had a long-term target of 50% CAGR growth rate for deliveries. Some analysts like Dan Ives think that's unrealistic, given the fact that would mean 2 million cars delivered by the end of 2023. When you have only 4 factories there, making 500,000 units per factory is a lot to do in 1 year. Ives says that Tesla and Elon Musk should come clean and cut that and make it a bit more reasonable, and that will assuage kind of investor concerns about Tesla going forward.
Because there's always that eye on those production numbers. A big thank you there, Pras Subramanian. Thanks so much. All right, coming up, we turn on the lights and dive into General Electric's Q4 earnings report and what to expect from the multinational conglomerate in 2023. Stay tuned.
All right, welcome back. And let's take a look at the markets and where they are right now. Whole lot of nothing. You're going to take a look at the Dow. That's up 7 basis points. The S&P 500 is down 7 basis points. By the way, that's 0.7%. Nasdaq down 4 of those. Russell 2000 up about 18. So not a lot of change going on. We did have that those market disruptions at the open on the New York Stock Exchange. That was resolved within the first 30 minutes, I believe. But now we're seeing real estate, industrials, consumer discretionary. Those are the top three. Their financials will throw that in. Very similar percentage amount. To the downside, energy is down 1%, healthcare down a little bit less than that, but not seeing any huge movers here. Let's take a look inside the Nasdaq. Dark green, we got Netflix up 1.3%, Qualcomm up 1.05%, but really just kind of a mixed board here. And then I'm going to check in on some of our leaders, and we are seeing, all right, home builders, that is up, that sector up about 0.9%. That XHB ETF right there. ITA, transportation, bets, that is gambling, MJ cannabis. So really not seeing a whole lot of movement here, kind of in par with the rest of the day. So we're going to take a quick break, and we'll be right back.
General Electric reported an earnings beat this morning with robust demand for jet engines and power equipment. Still, the company gave a disappointing forecast for the year due to problems in its renewable energy business. BofA Securities senior multi-industrials and industrial software analyst Andrew Obin joins us now to discuss. Good to see you, Andrew. I know that renewables missed your expectations. We're seeing investors really honing in on that with the stock price here. What do you think went wrong here?
Yeah, so look, our view is that the quarter was pretty solid. GE beat the consensus on EPS and actually free cash flow. I think the debate that's taking place is really about their free cash flow forecast. GE is one of the most complex companies out there, so the big debate, the role of progress payments in terms of their free cash flow forecast. Our take is that on apples-to-apples basis, It's fairly straightforward. We do think free cash flow is quite a bit better than the street is forecasting. I would say the fly in the ointment is that operationally, the renewable business is probably not as robust as the street has expected. But really, free cash flow has been the key focus for investors for this name. They beat very nicely in the quarter, and the outlook for 2023 is also quite a bit above street's expectations. But as I said, the debate is about progress payments. If you dig in, actually, on a net basis, what you have very strong aviation performance and solid performance in power, aided by the progress payments.
So let's dig into the aerospace, because I know you were also looking at military there for them. What do you like in this report?
Yeah, look, the big debate is that the pace of recovery in the aerospace, right? Obviously, also the supply chain has been gummed up on the commercial aerospace side. So what we're finally seeing the signs of this commercial aerospace recovery. We've been waiting for it for a couple of years, right? Investors been on and off. I think it's been a big disappointment for investors over the past couple of years. It's finally coming through. If you take a look at G stock's performance, it's trading in line with other aerospace names. I think the big story is the recovery in trans-Pacific travel that's probably coming throughout 2023. It's actually the biggest pool of profits for G Aviation. So we finally started to get nice visibility into 23, and we think that explains nice stock performance year to date.
And in his commentary, Larry Culp saying, looking ahead, GE is positioned to drive growth, profit and cash, and our outlook reflects our confidence in our businesses. What do you see as some of the weaker aspects of business? I know we talked about what we're seeing with renewables. Is there anything else in terms of headwinds that you're keeping an eye on?
No, actually, I would say, look, the issue is, as I said, we are going, the aerospace industry, got rid of a lot of people during COVID, and they're finding that it's really tough to ramp up. But it's a broader industry-wide issue. So I think GE is no different from the rest of the industry, right? And obviously, as GE starts delivering engines are less profitable than services, so the mix is going to turn somewhat negative. Look, and as I said, renewables, the wind turbine business has been a big disappointment in 2022. There is a big restructuring program. It missed our expectations in the fourth quarter, offset by nice performance in their core energy business. But we think that's the source of uncertainty. And the conversations we've been having with investors today, right, is just a view that GE really sees a straight line on restructuring from now through 24. And I think there are some questions among the investors as to, how much confidence we can have in that. But, I want to say that GE is taking material amount of restructuring of this business, taking out fixed costs. IRA is a huge material help here, right? It just changes. It's a game changer for the industry for the next decade. The question is, how soon are we going to see the impact of these positive changes in 23?
And as we talk about that spin-off into healthcare, what kinds of conversations are people having? What sort of time horizon are they looking at to really see that really taking off?
For renewable turnaround?
For the healthcare, yes.
Well, healthcare has been spun out, so healthcare is no longer part of the business. So I would say the other thing that happened today is that if you look at the outlook, right, some analysts still have healthcare as part of GE. And so what's interesting is that GE reported with healthcare, but obviously going forward, the free cash flow and earnings exclude healthcare, right? It's now going to be followed by healthcare analysts. So I think this is adding to confusion today, right? Because if you look at the consensus outlook, right, if you look at people's models, people still have healthcare numbers in their model. Actually, healthcare relative to our expectations was very good. It's just the issue is that some people still have healthcare as part of ongoing operations in 23, and it's a standalone separate company. Albeit GE still owns, a nice chunk of it, which will they monetize over the next 12 months.
And that's an important distinction because a lot of people sort of, jumping into the stock and wondering and not really getting too clear on that. So thank you very much. BofA Securities Senior Multi-Industrials and Industrial Software Analyst, Andrew Obin. Thank you so much for joining me this morning. All right, coming up, Capitol Hill playing the role of an anti-hero today as it takes on Ticketmaster in an effort to clear the bad blood with customers surrounding the debacle that we now know all well about. Well, we get to the bottom of this not-so-love story next. Turning now to the business of entertainment. A live event ticketing company is the mastermind behind the ticket jam-ups for Taylor Swift concerts. Well, the Senate Judiciary Committee holding a hearing today. You're looking at live pictures to determine just that. So here with more, we have Yahoo Finance's Ali Kanal. Hey, Ali.
Hi, Rochelle, I should say. But this hearing, yes, currently ongoing. We're well into the questioning portion of the day. But we have heard from several senators, including Amy Klobuchar, Mike Lee, along with Lindsey Graham, plus quite a few witnesses. Live Nation president and CFO Joe Berchtold, one of the main witnesses here today. And he admitted that in regards to the Taylor Swift fiasco, there were several obvious issues. There were things that they could have done better. But he did maintain that the crux of the issue was due to bot attacks. And that's been a big focus for a lot of these senators in their questioning so far. One witness, Jerry Mickelson, he's the CEO and president of Jam Productions. He slammed the bot excuse. Here's a bit more of what he had to say earlier in today's hearing.
Ticketing companies, one of the things they're supposed to do is have solutions to bots. And for the leading ticket company not to be able to handle bots is, for me, pretty an unbelievable statement. But you can't blame bots for what happened to Taylor Swift. There's more to that story that you're not hearing.
And just to rewind how we got here, Live Nation and Ticketmaster first merged in 2010. Since then, there have been repeated calls to break them up, as this is the company that serves as the promoter, venue, and ticketing service. A few other tidbits that we did receive throughout the course of the hearing so far include artists setting the base pay for a lot of these ticket prices, and then you have those high fees on top of that. That is apparently determined by the venue, with Ticketmaster controlling approximately 5% of venues. So the prices of ticketing, that's been a big focus. Another one is the long contracts that Ticketmaster and Live Nation have with these venues. Some of these venues have contracts that extend 10 years or more with Live Nation, and that obviously prevents competition. So still an ongoing story, a lot more to discuss, but so far it's very clear that the majority of these senators, along with the majority of the witnesses, believe that Ticketmaster Live Nation is a monopoly. Whether or not that's going to lead to any tangible change remains to be seen.
We'll certainly have to check. A lot of probably big concerts coming up this year. So a big thank you there, Yahoo Finance's Ali Kanal, for that update. Thanks so much. Well, business taxes are set to rise even as the economy shows some weakness. This according to a new report from Fox Business. Now, changes to federal taxes are set to begin in 2023 with a 15% profit-based minimum tax on corporations set to begin this year. And that's part of the Inflation Reduction Act. Still, with many of the changes happening this year, the effects won't be reflected and likewise won't necessarily come due in this year's 2022 tax season. Well, let's continue the conversation now because tax season is approaching, but where are all the accountants? The Wall Street Journal reporting a nationwide shortage of the profession. To cope, firms like Geltrude and Company are hiring overseas workers. Well, joining us with more is Dan Geltrude, Geltrude Company founder. Good to see you, Dan. So did you ever imagine we would get to this point? How did we get here?
No, I didn't. And really, my firm is nothing special in this regard in that we're at a point where it's not just about our ability to grow as a firm. It's about being able to handle the current workload. Over the last 2 years, 300,000 accountants have left the profession. So that leaves a huge hole here to be filled. And as you know, regulations and rules just keep increasing. So there's more responsibilities on accountants to get their work done, yet we have significantly less people to do the work. So it's really become a problem, and the solution really is twofold. First, more use of technology to the greatest extent possible, and then an international solution in trying to bring people on board that can help supplement our U.S. workers.
So then, Dan, as we talk about technology then, is it about getting more assistance for current accountants, or is it about more reliance on some of these apps and these other services that are becoming available?
Well, I think what's happening here is there is a level of work that certainly can be automated and technology can step into that. However, there is always a human factor in terms of reviewing the work. And then also there's that consultation piece with clients. It's about strategizing, and that's something that you really can't replace with technology. So there's certainly still a huge demand for accountants throughout the country. It's just a matter of how you use those resources and then how you supplement that with technology along with international help.
And Dan, you've called this a crisis and a real threat to capitalism. Why are accountants retiring so quickly, and how might we see this play out?
Well, let me go straight to what the potential crisis is. So if you don't have enough accountants to get all the work done, as well as auditors, how does that play out? Well, first and foremost, you start to say, okay, can all the tax returns that need to be filed on a timely basis, can all that work get done? The second piece of that, and perhaps even more potential for damage to the U.S. financial system, is what happens if you don't have enough auditors in order to be able to timely file all the SEC filings for all these public companies? Because once there is a crack in the credibility of the work being performed, the timeliness and the quality of the work, what happens? Investors start to question whether they can rely on the financial information that they're seeing for which they're making their investment decisions on. And if we ever get to that point, and we're not there yet, but we're moving in that direction, that's when you have a true financial meltdown.
And who would you say is most at risk? Is this smaller firms more at risk of this versus, say, some of these bigger institutional companies?
Well, actually, it's across the board, whether it's a large international firm or your smaller local firms, everybody is feeling the same pain. So clients are clients. The big firms have big clients and public companies. Certainly, it's a threat there, as I just outlined, related to SEC filings. And then as you go down to the local firms, you expect that your accounting firm or your tax preparer is going to be able to get your taxes filed on time, or filed at all. Maybe they just simply can't take on more work. So large or small, this problem has the potential to impact everyone.
And Dan, I know we talked solutions perhaps when it comes to technology, but what about sort of overseas hiring as well? Would that be enough to offset the risk of the shortage of accountants here?
Well, it's certainly part of the solution. Is it 100%? No, because what you also have is there's so much hiring going on internationally. We're starting to get to the point where are there even enough accountants around the globe? So again, I don't know why people are not drawn to the accounting profession. It's certainly a great profession and a very honorable profession. However, it just seems that people are shying away from it.
I mean, to be fair, it doesn't sound like the most glamorous of professions, especially, you see everyone on TikTok, you don't really hear them gravitating towards accountancy, but there you go. There are openings, clearly, that people should be paying attention to. Dan Geltrude, always good to have you. Geltrude Company founder, thank you for joining me this morning. All right, coming up, lab-grown meats could be making their way to your local restaurant and supermarket, but would you pay the price? We discuss next. As food tech company Upside Foods makes headway, lab-grown meat could be on a restaurant menu near you as soon as this year. Dr. Palmer is here with more. A lot of people sort of split on how they feel about lab-grown meat.
That's right. Well, they might get a taste of it soon because according and reportedly, Upside Foods aims to bring a product to restaurants this year in 2023 and then to grocery stores by 2028. Now, that's a similar timeline to what CEO Uma Valeti told us back in December. So like I said, consumers can get a taste soon. This comes 2 months after the FDA deemed that the cultivated meat product made by Upside Foods was in fact safe to eat. Now, it's important to note here that this is different than plant-based meat. They actually use a small sample of cells from livestock, then feed it nutrition, put it in steel vessels, and then what they say is processed to look and essentially taste like real meat. But of course, when this does hit grocery stores and those restaurants, its intention is to be placed next to the meat and poultry aisle, that is, as opposed to next to the likes of Beyond Meat and Impossible Foods. Of course, there are other companies in this space like Eat Just subsidiary Good Meat, who's also looking to make headway, get FDA approval, and then be launched in restaurants and grocery stores as well.
So then as we await all of this, then what sort of challenges does the industry face?
Yeah, well, Rochelle, first, it's getting you and me and people like us to essentially taste the product. That's why the introduction into restaurants plays such a key factor, sort of looking at it as a premium offering and looking at chefs certainly back this. But pricing also remains a key topic and a key challenge for these cultivated meat products. When we spoke to Upside Foods founder and CEO Uma Valeti back in late December, this is what he had to say when it came to pricing.
Our aspirational goal at the moment is to beat the conventional prices. But initially, we're going to start off with premium pricing when we come into the market, which we hope is really soon. And that's because we are on a small scale. Our labor force is really very highly, educated and requires a lot of time to put together the product that we're to put on the market. But in time, we expect our products to be at parity with conventional meat, but that's going to be 5 to 15 years away.
And of course, another challenge here is producing what needs to be to feed consumers at scale. So of course, once it is introduced in restaurants, once it is introduced at grocery stores, it really is scaling up to see and fulfill what they think is going to be a big demand. For context here, Upside Foods founder and CEO told us that right now their production facility currently is able to produce about 50,000 pounds of meat. Of course, that's nothing compared to the amount of meat that the U.S. nation as a whole certainly consumes, but they are currently looking for a facility to produce 50 times that, to range from 10 to 20 million pounds each year. So those three challenges: pricing, getting consumer demand to scale. Those are three challenges that Upside Foods and the entire, what they're calling cultivated meat industry, is facing as they look to go into restaurants and grocery stores sometime soon.
Great stuff, Dr. Palmer there. I might be tempted if they hand it out as a Costco sample. I might try it. Don't know if I'd buy a whole pack of it before I've had a chance to test it out, but fantastic stuff there, Dr. Palmer, for us. All right, well, let's get a final check of the markets before we go. As we see there, all three have now turned negative. We see the Dow there just slightly in negative territory, down about 8 points. The S&P 500 there off about 6 points there. And the tech-heavy Nasdaq in similar territory there, down 12 points, about 0.1%. And as we look at our top trending ticker, it's 3M, of course, based on those potential layoffs that were announced as we wait for those to lay out, and those were throughout the manufacturing sector. So we'll be keeping track of that story as well for you. Well, that'll do it for now. I'm Rochelle Cooper, and I will be back tomorrow at 11 a.m. Eastern. See you then.